If you're paying any attention to tech news these days, you probably heard about tons of layoffs that have been happening in recent weeks. Robinhood laid off 1,000 people, which is 30% of the workforce. Coinbase laid off 1,100, which is 18%. Shopify laid off 1,000, which is 10%. Stripe laid off 1,000. Snap laid off 1,280, which is 20% of the workforce. In short, lots of high-quality companies, but it is brutal out there. But what happened? Did all this opportunity just dry up all of a sudden? Well, that's not quite the case. There's still lots of opportunity to build great things and serve your fellow humans with technology. What has changed is that there are very safe ways now to earn a high rate of return that doesn't involve taking the risk of whether a technology will work or not. These days, you can take very low risk with traditional bank products and get 3% return. Take a little bit more risk, you might get 5, 6, 8%, 10%. Now in tech, you can get hundreds of percent, thousands of percent. Comes with risk. So you have to build a portfolio, which means you're not actually getting 1,000% on a whole portfolio. Maybe you're getting 15% or 20% over a 10-year period, which is still really, really good. You have to have access to those investments. You have to have the patience to have it illiquid for that period of time. So the companies who are building that future still are building that future, but they can do so with fewer resources because they have to extend their timelines. Essentially, they need to figure out how to do more with less. Now, one of the ways you value a private company is by looking at public market comps. Victory Ventures put together this resource that shows a bunch of public market comps and the private market equivalents. Here are examples of public software companies that have been public in the last 10 years. And you can see sort of in the $1 billion range, there's a bunch of brands that you might recognize. And then they've got the bucket of the $5 billion range, and there's a bunch that you might recognize. And then the $10 billion range, okay? Now, the other side of that, we have the private software companies. So we've got 400 companies in the $3 billion average value range. We've got 50 in the $5 billion value range. And we've got 15 in the $10 billion plus range. Now, if you're in the $10 billion plus range private, you need to figure out how to transition over to the $10 billion public range. You've got to have revenue on par with those or growth. And most likely, if you're a smaller private company, you're betting on your growth versus parity in revenue. The public markets reset, so do the private markets. But the private markets, because they don't trade every day, take longer to reset. And so as those are getting wound back and the valuations are being reconsidered, that's giving opportunity for the companies to reconsider their execution plan before they get repriced down. Is drying up all over the place. There's still great things to be built, but the valuations that were awarded a year ago may not be valid today. So the leaders of those companies need to make some hard decisions and call for some cuts.